In today's video, we're going to break down two of the worst retirement lies told by finance gurus that everyone believes. My company and I help clients all over the United States follow proven advice that allows them to achieve the retirement success they've been looking for. Unfortunately, the internet is rife with bad retirement advice, in many cases leading people to fall for the pitfalls that prevent them from achieving the retirement they've always dreamed of. Let's look at two dangerous lies promoted by some very well-known financial gurus. I want to start by saying that Dave Ramsey and Susie Orman have done a lot of good helping people with debt paydown strategies, the psychology around money, and just motivating people to get their financial houses in order. And while it's suitable for them to give general personal finance advice, retirement planning is an entirely different discipline, one that requires the professional giving advice to have experience helping individuals retire in real life. The first of these lies is Dave Ramsey's 8% withdrawal rule. Dave Ramsey does many things well, but his 8% withdrawal rule is one piece of advice that I find to be quite destructive. This rule is based on the same concept as the 4% rule, which was founded by William Bengen in 1994, where he states that retirees can safely spend about 4% of their initial retirement portfolio over a 30-year time horizon adjusted for inflation without running out of money. Let's say that Kathy and Sam have $2 million at the start of their retirement and will use an annual inflation rate of 3%. Using the 4% rule, they would safely be able to withdraw $80,000 in year one and then adjust that amount each year for inflation over that 30-year time horizon without running out of money. So in year two, with 3% inflation, they would pull $82,400. In year three, they would pull $82,872, and so on and so forth. The study used historical data on stock and bond returns over the 50-year span between 1926 and 1976. There are a number of underlying assumptions behind this rule, the most important being that the retiree must have at least 50 to 75% of their portfolio invested in stocks. After many stress tests, Bengen concluded that even during economic depressions, a 4% withdrawal rate would not exhaust your retirement portfolio over 30 years. This serves as a good rule of thumb for many DIY investors, though it does neglect to account for several risk factors that should be considered. High fees, the sequence of returns risk, which I'll review in just a minute, inflation, and just general psychology around money. You see, humans don't spend in a linear fashion, meaning that in reality, nobody is spending the exact same amount every single year adjusted for inflation. Some months and years we spend far more than others, and we as humans cannot stick to any method that's too strict or too rigid for any length of time. A great example of this is trying to lose weight, right? So crash diets and quick fixes only work temporarily before we give way to our old habits. The same way we'd feel if we were forced to spend the exact same amount of money every single year. We've all heard of the go-go years or those early retirement years where we're still young and healthy, and we spend a bit more than we did when we were working. Then we have the slow-go years where we spend a little bit less, and then finally the no-go years at an advanced age, where we typically only spend 70 to 75% of what we spent in our go-go years. This phenomenon is very real, and it's what I've seen for the past 15 years in working with retirees. So the 4% rule just isn't dynamic enough to work in the real world. Well, Dave Ramsey took all of the flaws of the 4% rule and turned it into an entirely unrealistic rule of an 8% safe withdrawal rate. If you watch his show or read his books, he'll say that if you invest in 100% stock via an S&P 500 mutual fund, that your rate of return will be 12% per year, and that based on that rate of return, you can safely withdraw 8% of your initial retirement portfolio without running out of money in retirement. So back to our original chart using $2 million. This means using his rule, you could safely withdraw $160,000 per year, or actually in year one, and then we can see that that amount inflates each year at 3%. Now, while it may be obvious why this 8% rule is just flat out unworkable, I'm going to break down the top 3 reasons. Firstly, the S&P 500's 50-year average return is 11.47%, not 12%. Dave Ramsey may have cherry-picked the top performing years to come up with that 12% return, but it's not an accurate long-term average. In fact, the 100-year average, which is much more thorough, right, and accurate as it has 50 more years of data, is only 10.69% per year, so almost 2% below his claimed rate of return. Furthermore, he neglects to account for very real things like fees and taxes. This exaggeration on his part gives investors false hope on realistic returns, which 1, puts their retirement funds at undue risk, and 2, may cause them to run out of money in retirement. This brings me to my next issue with his 8% rule, and that is the sequence of returns risk. We all remember the Great Recession of 2008 and 2009, where the S&P 500 lost 53.1% of its value. Did any of you know someone, or maybe that someone is you, that had to work longer than anticipated because they lost half of their 401k during that time frame? I do. That's when I first started in the business, and this is the risk that all retirees face. Experiencing a market drop in the early years of retirement can create problems that go well beyond the immediate hit to your portfolio. In fact, those who retire during a down market have a much higher chance of running out of money than those who retire during an up market. Think about it. If the market drops at the beginning of your retirement, your assets will be worth less and more will need to be sold to generate income. This can drain savings more quickly and leave fewer assets to generate growth in the future. Furthermore, it prevents the retiree from gaining back all that they lost during that market drop. And that is exactly why his 8% rule would only work if you happen to retire during a great bull run. If we use the 50-year stock market average of 11.47% per year, and I round it to 11.5% here, let's see what kind of results you could get with this rule. Let's say that you have $500,000 at the beginning of your retirement, and your 8% annual withdrawal will increase at 3% per year. In this row, you can see the returns, both positive and negative, that amount to an average of 11.5%, or the 50-year S&P 500 average. Certainly, I'm not going to use the Goldilocks 12% of return each year, because that's not at all how the stock market works. Okay, so 8% of $500,000 is $40,000, and we can see here how that will rise at 3% per year with inflation. In year one, the S&P 500 returns 33% while you withdraw the $40,000. In year two, the market loses 5% while you withdraw $41,200. You can see here what happens to your account value using these stellar returns during the first 10 or so years of retirement. You're actually growing your money while you withdraw your 8%. And again, if you happen to retire at the beginning of a great bull run, you can easily withdraw 8% of your initial retirement portfolio. And if any of you have access to that crystal ball that tells you when those years start and end, let us know in the comments below. Okay, all jokes aside, let's look at what could easily happen, which is that you retire at the start of a decade with a flat to a slightly positive return. You might ask, well, when has that happened? One example would be the lost decade from 2000 to 2010. Other examples include 1929 to 1952 and between 1966 and 1978. I want to point out that the returns I'm using in this example are the exact same returns that I used in the first example in exact reverse order. So instead of ending the 20-year time frame with a negative 28% year, we're going to start the 20-year time frame with that negative 28%. Year two is negative 3% here, where it's year 19 here. So if we start with the same $500,000 and we withdraw 40% in that same year, when the S&P 500 loses 28%, we then withdraw $41,200 while the market loses another 3%. And then in year three, the S&P 500 returns positive 21%. But by this time, you can see the damage that's been done. In fact, by year 10, they've completely run out of money using Dave Ramsey's 8% withdrawal rate. This is why it is so important to bucket your money upon retirement. More on that in my video here. And this doesn't mean that you need to stay conservatively invested throughout your retirement. It actually just means that you need to make sure that at least 5 years of living expenses are fixed, your first 5 years of retirement, within your portfolio, so that you're not forced to sell during a down market. The last reason this rule is decisively wrong is that there's already been a comprehensive study on the likelihood of retirement success, aka not running out of money, using an 8% withdrawal rate, and the results were terrible. After the 4% rule was published, 3 professors at Trinity University in Texas researched portfolio allocation and sustainability in retirement using withdrawal rates from 3% per year all the way to 10% per year. What they found was that a portfolio invested in 100% stocks only has a 74% chance of surviving for 15 years. This is not a good success rate, and 15 years does not come close to covering the average person's retirement. In fact, over a 30-year retirement, 63% of those with portfolios of 100% stock would run out of money. It's important to remember that Dave Ramsey makes a living on your views, and the more sensational his headline and the less people think they have to save and work, the more popular he becomes, thus the more money he makes. Okay, let's move on to the second worst piece of financial advice from a famous financial guru, and this one comes from Susie Orman. I actually really like Susie Orman, especially her budgeting tips, and find her to be very inspirational, especially for women in finance. However, she has a retirement rule that is so outrageously inaccurate, and that is her 5 million plus rule. In episode number 153 of the Afford Anything podcast, Orman told her listeners that 2 million is insufficient to retire early on. She said, quote, "But if you only have a few $100,000 or $1 million or $2 million, I'm here to tell you, if a catastrophe happens, what are you going to do? You are going to burn up alive. When asked what a safe amount would be, she explained that it would be in the millions, but that it depends on several factors, such as where you live, your expenses, and whether you own a home outright. She believes the amount you need to retire early on would be closer to 5 or 10 million. Not only is this clearly wrong straight off the bat, and I'll show you why in a moment, but the worst part about her saying this is that she's making her listeners feel guilty for not accumulating $5 to $10 million, which we know only very few are able to do. But she's also making them feel obligated to work much longer than they have to. I know this rule is completely bogus because our firm has helped hundreds of families retire, most with less than $5 to $10 million. But I want to show you using an example. Let me introduce you to Dan and Kathy Smith, a hypothetical Florida couple, both 58 years old, and they want to retire next month. Here's the basic overview of their investable assets. This does not include their home or other tangible assets, just their liquid investable assets. And this is because in retirement, your liquid assets are what actually drives your cash flow. So they have a high yield savings account worth $100,000 and a jointly owned brokerage worth roughly $375,000. The majority of their investable assets are in Dan's traditional or pre-tax IRA worth a little over $1 million. He also has a Roth IRA worth roughly $54,000. Kathy has a traditional IRA worth around $200,000 and a Roth IRA worth a little over $20,000. Now we're going to move to our flagship software, eMoney, to show you how we would analyze Dan and Kathy's situation. Here's their baseline. Dan and Kathy are 58, and we're using a life expectancy of 95 years old. Their goals are to be able to maintain their lifestyle at $100,000 per year, or just over $8,300 per month. This does include their mortgage, which is in a different section under expenses and taxes, which I'll show you in a minute, at just under $16,000 per year. You'll see here that under leave to heirs, it says $0. But that doesn't mean that Dan and Kathy want to leave nothing to their kids. It just means that whatever's left will go to them, but they don't want to downgrade their lifestyle just to leave their children an inheritance. Under net worth, we can see their liquid investable assets that we reviewed earlier, as well as the value of their home at $500,000 and their $200,000 mortgage. This brings their net worth to roughly $2.1 million. Now, Dan and Kathy want to retire next month, so they'll have earned half of their annual income for 2024, which is $75,000 gross for Dan and $45,000 gross for Kathy. Below, we have their full retirement age or age 67 Social Security benefits. Under expenses and taxes, we see that everything but their mortgage costs $85,000 net per year in today's dollars between now and their advanced age or age 85. Recognizing an advanced age reduced spend is really important because there comes a point where you just can't do what you did when you first retired, typically around 80 to 85 years old. This is otherwise known as those no-go years that we discussed earlier, where expenses typically reduce to 70% of your early retirement spend, which for them is $60,000 in today's dollars. The software will inflate these expenses at 3.5% per year. We account for their mortgage separately because it's only for a specific time frame, and the amount does not increase with inflation unless you have a specific type of variable loan, which they don't. Their annual mortgage payment is $15,672 a year and will be paid off in 17 years. The software will drop the expense at that time. The software also accounts for federal and state tax, but since Dan and Kathy live in Florida, it will only calculate federal tax. We're going to run several Monte Carlo analyses to determine if they are able to retire next month as is, and if not, what they need to do to get there. A Monte Carlo analysis is the best way to test the success of a financial plan. Simply put, the computer takes 1,000 different stock market scenarios between now and Dan and Kathy's life expectancy. A third of the scenarios use above average market performance, a third use average, and the final third use below average market performance. The computer then takes your baseline of information and it runs it against all 1,000 of these stock market outcomes, giving us a percentage of likelihood that you will make it to your life expectancy without running out of money. We're looking for a score of 85% or higher. But before we do this, we need to run an analysis on their current investments to see what they stand to lose in a major bear market, because I'm going to use that scenario as a stress test to run in the Monte Carlo analysis. Here we are in Riskalyze, and this is software that can quantify how much risk a client is taking so that we can see how vulnerable they are to the sequence of returns risk, which I explained earlier. Essentially, we want to make sure that Dan and Kathy can withstand a major bear market in the beginning of their retirement, so they do not run out of money in their 80s or sooner. Riskalyze scores portfolios from 1 to 100, 1 being cash, CDs, fixed annuities, high-yield money markets. Basically investments that can't lose value. The S&P 500 scores a 73, and Bitcoin, or a very volatile individual stock, would score 100. We can see here that their overall portfolio scores a 66 out of 100, and their asset class breakdown is 79% stock, 18% cash, or in this case a high-yield money market fund, and 3% other, which refers to some commodities. You can also see that each separate account has its own risk score. Under the overall score, we can see that their average annual return is 9.82%. This is great information, but the real question is, with this specific investment allocation, what do they stand to lose if we go into recession next year or their first full year of retirement? Under stress tests, we can see several scenarios and their outcomes, but I want to focus on the third scenario, the if a financial crisis were to happen again. This models what occurred between October 15th of 2007 and March 2nd of 2009, where the S&P 500 lost 53.1% of its value. If that occurred again, Dan and Kathy would lose 47%, or roughly $800,000 of their $1.8 million. This information is crucial because we need to ensure that they can succeed, even in the worst case scenario. Okay, with that information, let's go back to our flagship software and start running some Monte Carlo analysis to see how they do. Again, we're looking for a score of 85% or higher. We can see here that if they live to age 95 at their desired expenses, and there's no major bear market upon retirement, they have a 98% chance of success. This means that 980 of the 1,000 stock market scenarios were successful. That's not my concern though, as most of our clients will be totally okay if they can avoid a recession in their first 5 years of retirement. We need to make sure that Dan and Kathy can survive that. So if they lose that $800,000 next year, their chances of success go from 98% all the way down to 49%. And this is again due to the sequence of returns risk. We can also see that if Dan and Kathy both needed long-term care between 85 and 88 before passing away, their chances of success reduce to 25%. So clearly they need to make some changes. Through our investment analysis, we find that we can optimize their portfolio by bucketing their money, which increases their Monte Carlo chances of success from 49% all the way up to 81%. And if that's all they did, they would only need to reduce their annual spend by $2,000 per year or $167 per month. We can see here that taking both of their Social Security benefits early is not the way to go, and that if they don't want to reduce their spending at all, if Dan works just one more year, they hit an 89% chance of success and they're good to go. Now, long-term care is a different story. In the long-term care scenario where they both need care between 85 and 88, I'm going to model selling their primary residence at their age 85, as this is what the lion's share of people do that go into care facilities to help pay for the cost. Their Monte Carlo success rate is still only 66%. So if they want to be able to confidently self-insure, they will either have to reduce their spending by $9,000 per year or $750 per month, or Dan will have to work just 3 more years to age 61. Now let's look at Jim and Jennifer Smith, a completely different scenario. They are a California couple that's 64 and 63 years old, and they want to retire next year at 65 and 64 respectively. We have them living to age 95. They have just over $600,000 in investable assets between their high-yield money market account, brokerage account, and Jim's 401k. They own their home outright, which is worth $450,000. Here we can see their earnings for this year and next year, and below their full retirement age Social Security payouts. They want to increase their spending from $70,000 per year to $80,000 per year in retirement, or just over $6,600 per month. These expenses will inflate at 3% per year, as well as the advanced age spend, which we can see here is $30,000 less per year at age 85. We can see Jim's contributions here, the 401k and the employer match. And under protection, we can see Jim's term policy and both of their long-term care policies. They both have $300 per day for 3 years with no inflation. Now, I don't have time to break down all of the investment details as I did with Kathy and Dan, but let's run some Monte Carlo analysis. So based on our portfolio recommendations, we can see that Jim and Jennifer increased their Monte Carlo success score from a 75% chance of retirement success to an 89% chance of success. If long-term care is needed, and remember, they both have a policy, from 85 to 88, and they sell their home at 85 to help pay for the cost, their Monte Carlo success rate is just 82%. This means that if they want to account for long-term care, they would only need to reduce their spending by $2,000 per year or $167 per month. As you can see, retiring early successfully does not take a minimum amount of money, but rather an optimal investment allocation, retirement date, and the right annual spend. The moral of this video is to not let famous financial gurus guide your specific retirement decisions. These 2 rules are so easily debunked but you need to be extra cautious when listening to this type of media. Every person's ability to retire is different and depends on far too many factors to sum up into one or two neat rules of thumb. Now you know to take a more considered approach to your retirement. However, there are several other details that I haven't been able to cover in this video. If you want a team of professionals to analyze your situation and understand how to time your retirement to meet your goals, click the first link in the description. It will take you to a page where you can book a completely free consultation with us, where we can begin to help you build the retirement of your dreams.